Preferred stocks explained. Higher income, lower risk? Most people don't know this exists. But Wall Street has been using preferred stocks for decades to generate steady income while sleeping at night. And starting right now, you can too. Hey, I'm breaking down preferred stocks today because they're literally the middle child between bonds and regular stocks that nobody talks about. By the end of this video, you'll understand whether they belong in your portfolio and how to actually buy them. Let's start simple. You probably know regular stocks, right? You buy a share. You own a tiny piece of the company. And you make money when the stock goes up or when they pay dividends. But here's the problem. When markets crash, your shares crash with them. You saw this in 2020, 2022, and every other correction since forever. Preferred stocks are literally the bridge between those two worlds. When you buy a preferred stock, you're not quite a real owner anymore. You're more like a lender who gets treated better than regular shareholders but worse than actual bondholders. Sounds weird? Stick with me. Here's the actual mechanics. Companies issue preferred stocks to raise money without taking on debt like bonds. In exchange, they promise you a fixed dividend payment every single quarter. We're talking 6 to 8% annually, sometimes higher. Compare that to the average dividend on regular stocks, which hovers around 1.5 to 2%. That's literally 3 times the income. So where's the catch? There's always a catch. Part 1. The income advantage. Let's say you buy 100 shares of a preferred stock from Bank of America trading at $25 per share. You spend $2,500. That preferred stock has a stated dividend of 6.5% annually. That means every year, you're getting around $162 in quarterly payments. Consistently, predictably, without worrying if the company's earnings beat expectations. This is why retirees and income-focused investors love preferred stocks. You get paid to wait. You're not gambling on growth. You're not hoping the stock price goes to the moon. You're collecting a paycheck. Compare this to buying the S&P 500 through Vanguard or Fidelity. You're getting maybe $20 per $2,500 invested annually in dividends, plus hoping for capital appreciation that isn't guaranteed. With preferred stocks, that income is locked in by the company's legal obligation. If they don't pay, it's a massive deal. Part 2. The catch. What actually goes wrong? Here's the reality that changes everything. Preferred stocks are not protected like bonds. If a company goes bankrupt, bondholders get paid first, preferred shareholders get paid second. Common stockholders get whatever scraps are left, which is usually nothing. You're above common shareholders, but you're below actual creditors. The second issue? Your stock price actually matters. Even though you're collecting that 6.5% dividend, if interest rates go up, the value of your preferred stock goes down. Here's why. Imagine you're holding a preferred stock paying 6.5%, and suddenly new preferred stocks are being issued at 7.5%. Your 6.5% share is now worth less because investors want the higher yield. If you need to sell before maturity, you might take a loss. Third thing, some preferred stocks are callable. This means the company can basically say, "Thanks for the investment. We're done with you," and buy back the shares at the original price. This happens when interest rates fall and they want cheaper financing. You're capped on upside but not downside. Part 3. Is this right for you? Here's my honest take. Preferred stocks are best in a specific situation. If you've already maxed out your Roth IRA, your 401k, and your brokerage account at Robinhood or Fidelity, and you're looking for stable income, preferred stocks deserve a look. They're not a core holding. They're 5 to 15% of an income portfolio maximum. If you're under 35, you probably don't need these. Your timeline is growth focused. Time is your advantage. But if you're 50, semi-retired, and need quarterly paychecks without touching principal, preferred stocks shift your entire strategy. You can buy preferred stocks directly through any major broker. Just search the ticker plus the word preferred. Bank of America Preferred is BACPA. Wells Fargo is WFC Place. Most preferred stocks trade between $20 and $30 per share, and they're liquid enough to sell if you need to. The bottom line: preferred stocks give you higher income with lower volatility than regular stocks. But they're not risk-free, and they're definitely not for everyone. They're a tool for a specific phase of your investing journey. If this breakdown helped, hit that subscribe button. We're breaking down every corner of personal finance so you can actually build wealth instead of guessing. Thanks for watching. See you next video.